Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, and this is really one we're going to do for both the months of July and August, I want to get into actually a concept that we talked about at the beginning of the year with our outlook, which is embracing change. Now, we're here just past the middle of the year, and the reality is we're expecting change in a few ways. Among them, basically a market rotation that we have seen start at least, and we'll get into that a little bit. And then, of course, secondly, a lot of changes even in the election as we're headed up and headed towards the November election here in the U.S. So, the whole idea is we're going to get into how some things are shifting. It reminds me of our outlook sort of theme, which is embracing change. Like we got to get ready for it and kind of, and sort of jump into it. So with that, let's jump into the session. And I want to kick it off by really talking about, number one, the economy and sort of where things have been, where we think they're going. So one shift we think that is happening right now. But recall, as we've discussed before, that the first half of the year has been sort of driven by optimism around artificial intelligence. We've talked about before, there's estimates that global GDP could be, round numbers, $15 to $16 trillion more productive by, let's say, 2030 because of artificial intelligence. And we know there's certain stocks. A good example, of course, being NVIDIA, that has just driven really, really much higher because of their important role that they play in the in this sort of economic development from artificial intelligence. And one of the things we profiled this month in a few different ways that we're publishing things is to talk about use cases. So, there's just so many. Like we sort of said, hey, let's put together some material, some thoughts on how AI might be used. And it's almost like there's so many different ideas or things that are actually happening, right? And so, for example, that there's AI starting to be developed in financial analysis. That it's been used a bit in consumer experience. So think of things like, music services or sort of making discovery of interesting information for a consumer easier. There's applications we've talked about like in agriculture, technology, other areas of retail, et cetera. So just a ton of different use cases for AI. And that's led to what's been a stronger than expected in general sort of economic environment. And that was sort of capped recently by the first estimate of second quarter 2024 that came out at 2.8% annualized. And so think of that as, significantly above the consensus estimate of about 2%. And so, the economy in this first half was really kind of screaming, driving hard. And in that last print, so the second quarter, it's basically all three components. So it's consumer, businesses, and government all contributing quite significantly to that GDP growth. Now, we'll get into it in a moment, but we're in the camp that we're going to see a slowdown in the second half. This is one of those changes I'm mentioning. And so sort of related to that is an update on the Fed and policy and inflation. So what we've seen is a slowdown or cooling of inflation itself. So measures like Consumer Price Index and the PCE, which recently came out, where those numbers have definitely cooled down a little bit. Producer Price Index, there's actually the most recent print was a little firm, but think of it as the levels are kind of down around the neighborhood that the Fed would want to see. And so the open discussion is, okay, when's the Fed going to cut? A second element of their communication that has been, though, that they want to see evidence for longer. So honestly, futures right now are pricing in the first cut at the Fed's September meeting. We happen to think it's going to happen later in the year. I call it December, perhaps. And yet the markets are once again just a little bit ahead and thinks there could be 2 to 3 cuts this year, And again, we're in the camp that maybe that won't happen quite as quickly. Regardless, with these level of Fed funds rate and market interest rates, as we've discussed before, we're one of the sources of sort of economic friction is this idea of, in this case, consumers having to deal with higher costs of debt. So this idea of fiscal transition. And so, tons of additional debt was added since the financial crisis when rates were low. And now that rates are back up, basically the consumer, businesses, and the government all have to deal with increasing costs of debt. And so the consumer, once again, we're seeing just little glimpses of indications that the consumer is feeling some pressure. So we've heard that when it comes to earnings season and what different CEOs are saying about the consumer, but also we're seeing it in the data. So both the consumer sentiment indices and the measures and the consumer confidence measures, especially around expectations, think of them as just below sort of neutral, right? So they're signaling some concern. And then we've seen sort of retail sales bopping around a little bit below the long-term average. So when we try to dig in and see why, among the things that we're seeing are a couple of stress points. One is the interest paid on consumer debt. So I think let's talk about mortgage debt and non-mortgage debt. Mortgage debt is typically, or a lot of it is fixed. So it's only when somebody pays off their mortgage, usually from selling a house, and then goes and gets a new mortgage, will the rates kind of creep up. But they are moving up, right, as that kind of change occurs in terms of mortgages. What's more notable is the non-mortgage debt is often variable. And so we're seeing numbers showing that the interest rate on that type of consumer debt, non-mortgage debt that's variable, is going up a lot. Not surprising because rates have gone up, right? So they've really climbed. I think in terms of the amount paid going up, call it 50%. So just imagine on average, the average consumer having to pay 50% more in interest is actually quite a significant increase in the cost of debt. And so what goes with that then is a bump up in delinquencies. So all of a sudden there's a little bit of stress. You can think of things like credit cards or auto loans where we've seen a little bit of a jump in delinquency data that is again showing us that the consumers at least struggling a little bit to kind of pay those bills off. And so these are the signals, right, that we're talking about to anticipate a consumer slowing down. In any event, then when we take a kind of a look at what we're seeing in terms of economic forecasts for the economy, again, that the first thing I'll mention is that second quarter first estimate of GDP, 2.8%, well above the expected level. But even the consensus forecast is for things to cool back down to, let's call it a growth rate of about 1.5% for the third and the fourth quarter. We actually think it might fall a little further than that, but also we're of the view that we're not expecting to see a recession anytime soon. So with that, I want to turn to sort of a second major topic, and it is around change, and that is the election. So I guess to start, I wanted to take a quick minute and kind of explain what's happening in terms of the timeline, and then we'll get into obviously some major changes that have occurred. So first, to get to the timeline, there's one point of potential friction where even though some have said that this issue has been resolved, essentially Ohio law does require, we think, that the parties certify the presidential ticket by August 7th, and that would allow the individuals' names to be on the ballot. And the Democratic National Convention is slated for August 19th to 22nd. And so there's a possibility that there will be a vote, and we'll get into it, but for Kamala Harris to be named for the Democratic Party in advance of the convention, unless they really think they don't need to do that because it can still get around the Ohio ballot. But anyway, that's sort of a point of tension out there. We've got potential presidential debates in September and October, and then Election Day on November 5th. It'll be December 17th that the Electoral College votes, and then inauguration happens on January 20th. And by the way, to look back in time, the Republicans had a very unified kind of national convention. It's sort of signaling that the party is kind of really coming together and rallying around the sort of the preferences and views, if you will, of Donald Trump. And in fact, I'd take the opportunity to just mention that really for different reasons, we're seeing the parties become more unified. So, for example, with the Republican Party, a little bit more unified around populism, or that idea that they want to appeal to the concerns and interests of ordinary Americans more than the quote-unquote elite, and where they want to emphasize nationalism, a lockdown on illegal immigration, and economic policies to spur growth and protect American jobs, for example. Whereas Democrats, as we know, especially with Kamala Harris coming into the picture here, are essentially set to rally around progressive values, think social justice, economic equality, government, sort of bigger government with more government intervention, all around really wanting to, help people. So they're going to focus on renewable energy, kind of taxing the wealthy to provide social services like universal health care, things like that. And so again, it's what's interesting is it's almost like both parties are kind of coalescing around their views and their policies and all that kind of thing. In any event, to move along, as it relates to the election itself, all three sort of branches are, of course, in play. We've got the White House with, many states defined to be leaning or likely to go Republican, other states intended to go leaning or likely Democrat, and then a bunch of battleground states. And so, as ever, people are pretty focused on the battleground states. And then as it relates to Congress, of course, the entire House is going to be reelected. And yet on the Senate side, it's more Democrat seats that are up for election, 23 versus 11 for Republicans. So that, there's slightly more opportunity, at least, for Republicans to take seats in the Senate. With that said, we use a variety of different measures to try to track how things are going. And of course, as we've seen, really starting with President Joe Biden's sort of poor performance in the recent debate, that sort of set things in motion on the Democratic side for him to eventually withdraw from the race. And then Kamala Harris basically has been sort of the various party leaders and others have signaled support for her. So basically, it's almost like a swap, where she's going to be put forward as the candidate, and that's been helpful to the Democratic Party because it gives them something sort of to anchor on. And what we've seen as a result is with sort of the prediction analytics and things like that, is that Trump had sort of broken 60%, maybe think in the neighborhood of 65% chances of winning. And that number's come down a little bit. It's still, hovering around or just maybe just below 60%. But we've seen a big jump, of course, in the chances of Harris winning, given kind of that the whole sort of Democratic machine is sort of now rallying behind her. And interestingly, as it relates to one metric, and this is the probability as measured by these models of a Republican sweep, that number sat at a little over 45% right before that debate. It's still the most likely of the scenarios, but it's come down to round numbers of about 35%, right? So there's this recognition, not only that having Harris defined on the ticket, having everybody rally around that, and then that affecting the potential for the two houses of Congress, basically these probabilities have moved around a little bit and moved a little bit away from favoring Republicans towards Democrats. Now, when it comes to the candidates, I mentioned the idea that there's sort of a unifying sense in both parties. But, things that we look at as both the platforms and market implications or investment implications. So when it comes to the candidates, basically on the taxes side, of course, Trump will favor things like potentially extending the 2017 cuts and maybe bringing some rates lower. Harris not so much. Maybe extend, but I even read an article just today saying that, yeah, she's not going to do that. And the Democrats are going to really focus on bringing corporate tax rates higher and things like taxes on gains higher. On the environment, we would see some unwinding of some of the sort of clean energy type of activity if Trump's elected, but doubling down on that if Harris is elected. With healthcare, there's a preference to kind of repeal some of, or if not all of, the Affordable Care Act if Trump is elected. Harris will just drive it further if she can. In any event, with regard to foreign policy, say it from a couple perspectives, just generally Trump being more America first minded, whereas Harris we expect to be a little bit less aggressive with that. Although both are going to be tough on China, we just think Trump will ultimately increase tariffs more, whereas Harris, you can think probably more status quo. Now, finally, as it relates to regulation, there's a recognition that the Democratic approach and the progressive approach is to use regulation to advance preferences and policy. So we would expect increased regulation in the area of energy, technology, and financial services, whereas if Trump is elected, we would expect to focus on deregulation, basically unwinding some of the things that are already in place. And so, again, a lot of different things to think about. When it comes to investment considerations, we see tailwinds for the Trump side to be financials and energy, given the weaker regulation, probably increased spending in defense, and a focus on domestically oriented producers and small businesses, so more onshoring into the U.S. And tailwinds for Trump would be companies with a lot of China exposure because of the tariffs, and investments in renewable and clean energy as those sort of preferences are unwound. Now, if Harris wins, then we would expect, again, a doubling down on renewable and clean energy, including electric vehicles, for example. And then industries, if they're going to be more tolerant of immigration, industries that are kind of reliant on that. In any event, headwinds in the Harris realm would include financials because of increased regulation and maybe higher capital requirements, for example, and as well as technology, where there'd be just continued scrutiny on mergers and acquisitions. Now, as it relates to the way the markets behave, the reality is every election year is different. Markets kind of go all over the place, but one pattern we tend to see is coming up to right before the election, there's often a little bit of a jump in volatility, number one. And then number two, on average at least, after the election, the market feels a sense of relief and tends to go up a little bit. And so it's hard to know in terms of this environment with all the other forces in play whether those two things will be affected or influenced or driven to happen by the election, but we'll see. Now, I do want to say on the election one thing, which is to invite folks to view a client webinar. I'm holding it on July 30th with Stifel's Chief Washington Policy Strategist, Brian Gardner. And so I'm going to try to remember in the show notes of this episode, in the notes of this episode, we'll put a link that's either going to take you to the invitation, if it's not yet July 30th, or it's going to take you to the replay. And so I invite you to check that out. We'll dive just a little deeper in some of the things we're just talking about. Now, I want to turn and talk about sort of the last topic for this episode, which is the markets. And so some of the changes we're seeing. Number one, the yield curve, it's still high on the short end, awaiting the Fed cutting rates, but call it from about the 5-year out, the curve has taken a shape that's much more similar to sort of a long-term and normal Treasury yield curve. That's a signal that the market's expecting the Fed to start cutting and for things to calm and normalize a little bit. All that said, yields remain higher, and so that tells us that fixed income investments looking forward are attractive. On the equity side, we've seen a little bit of softness in the market. So we're still seeing markets priced at about a 20% premium based upon traditional price earnings, But as we've talked about before, that equal weighted approach is actually about fairly valued overall. And one of the things we wanted to point out is that the strong performance last year and year to date this year is driven to a good degree by earnings expansion. So the price per earnings going higher. And if anything, this year and last year, the earnings growth itself has been a little bit muted. And so anyway, think of it as the contributions to return being driven more by optimism and an expansion of price earnings ratio. In any event, with that said, what we do see is some evidence that there's been such a focus on the Magnificent Seven and big tech-oriented companies. We're actually seeing an expansion of sort of earnings growth into other sectors. So think of things like healthcare, like financials, and consumer discretionary stocks, where we're just going to expect to see. So think beyond tech, for example, some earnings growth sort of kick up towards the end of 2024. So that's leading to, anyway, this recognition that there's been a little bit of a rotation in the market, which we've been talking about. And for the current time period, it actually happened at the close of July 10th, where essentially the cap-weighted S&P 500 since July 10th is down a little over 4%. The equal-weighted index is up a little bit, 1.3%, which for 2 weeks is pretty good. And then when we look at things like financials, it's up a little over 2. When we look at the KBW regional banking index, it's up over almost 17%. And then the flip of that is you look at stocks like the Magnificent Seven as measured by the Bloomberg Magnificent Seven index is actually down almost 13% from July 10th to July 25th. And so just think of it as a rotation from what we were seeing year to date through that date. And so it's something we've been expecting. It's almost like the sense that the market got a little bit ahead of itself, especially led by those Magnificent Seven stocks. So it's a natural thing, especially as we anticipate a little bit more of a slowdown for things to cool off a little bit. And we do remind ourselves that that idea of the benefit, or I'm sorry, maybe a better word is the dominance of the market cap weighted index versus the equal weighted, that ebbs and flows every year or two or three. So we could be well into a rotation as it relates to that. In any event, I want to point out, we're here towards the end of July. We've got a lot coming up in terms of, activity, Fed meetings. We're going to see data on things like retail sales, more data on the consumer in terms of sentiment, and then through the balance of the year, a number of Fed meetings, et cetera. So a lot to kind of monitor in terms of looking forward. As ever, I invite you to check out stifelinsights.com for this work and a bunch of other things. And so with that, I want to thank you for listening to this episode. And we'll be back to you in September. Thanks so much.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.